Good morning. My name is Eamon Dundon. I'm the Director of Advocacy here at the Portland Regional Chamber of Commerce. Welcome to Growth Basics for Business. This is our monthly morning webinar series that provides a forum to gain useful workplace solutions and insightful, actionable tips for your business. Today is our 9th event in the 24-25 season of Growth Basics for Business, and I want to extend a thank you to Eaton Peabody for their continued support of this virtual event series again this season. This morning's topic, Maine paid leave, state versus private, is presented by Rich DeAlbert and Mathew Bowler of Cross Insurance Total Absence Management. Today, they will walk us through the basics of Maine's new paid family medical law, probably a refresher for most, maybe some new information for some. And then they'll pivot into a more in-depth discussion on considerations for employers as they evaluate going with the default state plan or applying for private coverage. It is important to keep in mind that the paid family medical leave program is still in flux, both due to litigation and active legislative proposals that are seeking to amend the statute governing the program. Just yesterday, in fact, the legislature's Labor Committee met to consider 13 bills related to amending the paid family medical leave program. One of those bills in particular emerged with a minority report that is likely to have bipartisan support on the floors of the House and Senate that would make important amendments that the Chamber supports, really around easing employer compliance, making the fines a little bit more fair for employers should there be mistakes, and giving them an opportunity to correct mistakes over the coming year as we all get used to this program. There's also amendments in there to ensure the solvency of the fund. And so there's some changes to when and how benefits get paid out, because that is a concern that we have, that the fund will become insolvent, the state fund, I should say, at a certain point, necessitating, emergency tax hikes to fix the gap. And then the final thing, which is of great importance to this call this morning, is that amendment includes fixes to the statute to clarify the original legislative intent as we saw it around private plans. When this bill passed last year, the legislature made it very clear that they intended to exempt employers who have a private plan from paying into the program. And then when the rule came out following passage of the law from the Department of Labor, they included a provision in the rule that would require every employer to pay in for at least one quarter, even if they were electing to go with private coverage. And so we saw that as a big gap between what the law said and what the intent of the legislators passing it said, and then what the department ended up implementing. This is also the subject of litigation, but this would provide a legislative fix to that problem and provide a refund to those employers that are going with the private route. This does remain a dynamic situation, and so should you want to follow the latest updates, we do encourage you to go to our website, portlandregion.com, and sign up for our advocacy updates. We'll continue to share timely information as the full legislature continues these bills in the coming weeks. They could hit the floor of the State House as soon as next week, or it could be 4 weeks from now when they're wrapping up their business. It's very unpredictable, but we will share the latest information as they consider these bills and let you know how you can reach out to your legislator should you want to share concerns. Like all of our virtual events, today's presentation is free and is being recorded. It will be made available for free replay on the Chamber's website and YouTube page. As I mentioned, you can visit our website to sign up for our email newsletter, and you can check out our social media on Facebook, Instagram, and LinkedIn. Before we begin today's program, I just want to remind everyone that we are using a platform called StreamYard. This platform provides improved production and interactive elements that truly enhance our virtual events. And on that note, I'd like to point out that when you have questions for our presenter today, you can type them into the YouTube chat throughout the presentation. We've reserved time at the end of Rich and Matthew's presentation for a Q&A session. And everyone here this morning will have the opportunity to ask a question there. So please do not hesitate to engage in that conversation, and we will get your questions answered. At this point, I'd like to acknowledge our presenting sponsor of Growth Basics for Business, Eaton Peabody. For over 7 years, Eaton Peabody has been the presenting sponsor of this series, and they've continued their support this season. Eaton Peabody is a full-service Maine-based law firm with nearly 50 attorneys serving Maine clients from offices in Augusta, Bangor, Ellsworth, and Portland. They assist companies of all sizes in a variety of industries. So whether you're an established financial institution or a small business taking the first steps, they can help you with all your legal needs. To learn more about the services they provide and the industries they serve, please visit their website, eatonpeabody.com. Also, be sure to follow them on LinkedIn to stay up to date on legal updates and future community events. And so now I do not want to take any more time away from our presenters this morning. Plus, I think everyone has heard enough from me on this topic of paid family medical leave. So with that, I will hand things over to Rich and Mathew. Guys, please take it away.
Awesome. Thank you so much, Eamon, and good morning, everybody. Thank you for joining us today. We are really excited to be here representing Cross Total Absence Management. We work closely with employers across the country to help them navigate the really forever evolving world of leave, disability, and paid family and medical leave management. And as you're probably well aware, Maine is taking a major step forward as a state and becoming the 13th U.S. state to implement a mandated paid family and medical leave program. For the purposes of brevity, I will refer to paid family and medical leave as PFML a lot during this presentation. I want to make that clear up front. So with this shift in Maine, it comes a lot of questions, inevitably, how the state program will function, what employers need to be thinking about now, and perhaps most importantly, how to ensure whatever path you choose, state plan or the private option, that you're set up for success as an organization. So today's session is designed to give you that knowledge, the knowledge you need to make an informed decision around that. We'll take a close look at the Maine PFML program, how it's designed, what it means for your organization. We'll walk through key differences when comparing the state option with private plan option. And remember, our goal isn't to sell you on one path or the other. We want to make sure you're prepared, proactive, and positioned for a smooth rollout of the program. That said, we've seen firsthand how employers who explore that private option, the private plan option, can gain greater control, flexibility, support for both their HR teams and their employees. So with that, let's go ahead and dive in. Before we dive fully in, I do like to make a disclaimer that Mathew and I are not lawyers. We are paid family and medical leave subject matter experts, and we source the information that you'll find here today from the jurisdictions available resources. However, things change rapidly, as you know, right? Eamon just gave the update on rulemaking that's going to impact this program, and we'll likely see more of that as we get close to May of next year. Oh, pardon me, getting ahead of myself. So for today's agenda, we'll start by getting a high-level view of the paid family and medical leave status across the country, what different approaches states are taking. We'll review how the Maine PFML program came to be, familiarize with its aspects, and we'll talk about integration considerations, such as how new private paid family and medical leave benefits may interact with things like your internal short-term disability program, your PTO program, sick time, any internal paid leave policies you may offer. We'll take a quick look at a tool we utilize at Cross Total Absence Management to understand whether choosing a private plan is a financially sound decision. And then as Eamon mentioned, we'll leave time for questions at the end. So without further ado, Mathew, I'll go ahead and pass the torch over to you so we can take a look at the bird's eye view of PFML in the United States.
Yes, thank you, Rich. We're going to kick it off with a brief overview of the current PFML landscape. I'm sure many of you have seen a version of this map before, so we're going to move pretty quickly at a high level. As of now, there's 11 states with active PFML programs in place across the country. These are the states that you see here in dark green. In addition, 4 states are in the process of implementing a PFML program with go-live dates scheduled over the next couple of years. These are the states that you see in the lighter green and include Minnesota, Maryland, Delaware, and Maine. You might have seen that Maryland proposed a potential delay in their program. It hasn't been finalized. It still needs that governor's signature. So if you have a population in Maryland, keep an eye out for that. We are seeing a growing number of states introducing or seriously considering PFML legislation. 2 states that come to mind are states like New Mexico and Illinois. And then lastly, it's worth noting that there's a small but notable pocket of states in the southern part of our country that offer voluntary PFML programs. So a lot of movement happening in the PFML space, and we expect that to continue over the next several years. Now, focusing on Maine specifically, Maine paid leave was established when Governor Mills signed the state budget into law back in July of 2023. The program will be funded by a payroll tax split between the employer and employees, with program contributions beginning back on January 1st, 2025, and benefits becoming payable at the beginning of May 2026. The law will apply to all employees and employers in the state of Maine. The only exception is the federal government and its employees. Of course, they're exempt from the law. Employers can participate in a state plan, but also can opt out and apply for a private equivalent plan through a approved insurance carrier. I believe the last time I checked, there was 20 approved insurance carriers in the state of Maine, so there's quite a bit of options. I want to take a moment to acknowledge the Maine PFML rulemaking journey. While many of these milestones you see here are now behind us, they help illustrate how we arrived at where the program stands today. The rulemaking process followed the Maine Administrative Procedures Act, with formal rulemaking kicking off in the spring of 2024. Throughout the rulemaking process, the state of Maine held several public listening sessions across the state to gather input and address any questions. Draft rules were then published, followed by a public commenting period for the state to hear any and all feedback. The department then reviewed the feedback that they received and made adjustments where they felt appropriate. While the foundational rulemaking is largely complete, we're now in a critical operational phase. As of January 1st, 2025, employers should have been remitting those PFML contributions, and employers considering a private equivalent plan, it is important to remember there's a deadline to submit your exemption request if you want to avoid paying into the state plan for Q2. That deadline is quickly approaching. Have those applications submitted by the end of this month if interested.
All right. Thank you, Matthew. So we know how we got here, and let's take a look at where the program landed and how it's designed. So starting off with eligibility, how does one determine whether an employee is covered under the Maine PFML program? So an employee will be covered if they've earned at least 6 times Maine's average weekly wage, so the state average weekly wage, in the first 4 of the last 5 completed calendar quarters preceding that employee's need for leave. So the state average weekly wage, as you may be aware, changes on July 1st of each year. And based on the current state average weekly wage, which is $1,144.67, to qualify for Maine PFML benefits using that current value, an employee would need to have earned approximately $6,864 in covered wages during that essentially year look back period to qualify for Maine PFML benefits. I always like to put this into perspective and compare to a couple of our other more recent programs that went live. So looking at the state of Colorado, their program launched recently. Their eligibility is actually based on a wage threshold of $2,500. Looking at Oregon, whose program went live in late 2023, their eligibility threshold for employees is a wage amount of $1,000 in that year look back period. So it's good to put it into perspective. Maine's sitting about $6,800 wage threshold, so significantly higher than those 2 recent programs that went live. Now, employers are covered if they have at least 1 employee working in Maine, and of course there are some exclusions. Contractors aren't automatically covered, self-employed individuals, tribal government can opt in, federal government is excluded, as Matthew mentioned. Now, who pays for this program and how much are they going to pay? It's a 1% of taxable wages premium rate. And as we're likely all aware, those premiums started getting pulled from employee paychecks as of January 1 of this year. Employees can't be made to contribute more than the Social Security taxable wage base in a given year. This year, that value is $176,100, meaning once an employee has contributed premiums on that amount of wages, they're not going to contribute on any wages they earn beyond that this year. Now, employees can be made to pay up to 50% of Maine's contribution rate in any given year. So currently with that 1% of taxable wages rate, employees can be made to pay up to 0.5% of taxable wages into this program. The employer, of course, can choose to cover some or all of the employee's portion. But again, the important thing to remember is an employee can never be made to pay more than that 0.5%, at least at current time. Now, how much does the employer pay? If the employer is considered a large employer under this program, they would owe an equivalent 0.5% of taxable wages, totaling that 1%. What constitutes a large employer in Maine? The answer to that question is you need to have at least 15 Maine employees. So if you have less than 15 Maine employees, you'd be considered a small employer, and your responsibility would be limited to collecting that 0.5% contribution from employees and remitting it. Something unique about Maine that I like to call out, and different PFML programs take different approaches to how they set up their premium rate in the beginning years, in the formative years of a program. But Maine will be keeping that 1% of taxable wages premium rate in place for this year, next year, and the 2027 year. So they've essentially frozen that 1% rate in place for a few years, which does provide some stability. And they will evaluate whether or not to increase or decrease that rate, getting closer to the 2028 year. All right. Maine makes it pretty easy to remember how much time you can take in terms of paid leave under the program. It's 12 weeks of leave available in a given benefit year between all of the leave types that an employee could claim. So it could be any combination of, say, medical, family care, parental bonding, even safe leave, military exigency, military caregiver, and even organ donation. You can't claim more than 12 paid weeks in a given year. And so it's a pretty easy number to keep in mind, and certainly aligns with the federal FMLA's 12-week value, if you will. Now, how much do employees receive through the program? The maximum weekly benefit amount is actually capped at the state average weekly wage in Maine. So currently, that value is $1,144.67. So if benefits were paying today, the most an employee would be receiving per week would be that amount and no more. So about $1,144, which is a substantial weekly benefit amount comparative to the maximums of other state PFML programs. How will the state and how will private carriers land on an employee's weekly benefit amount? I won't bore you with the details of Maine's sliding scale, and they're outlined here. But essentially, know that Maine will be using a 2-tier sliding scale, and a benefit of the sliding scale setup is that employees with, those lower wage earners in your population tend to receive more complete income replacement through a sliding scale setup. So that's the approach Maine will be taking. And I think I'll go ahead and transition it back over to you, Matthew, to talk through limitations and exclusions.
Yes, thank you, Rich. As Rich mentioned, under Maine PFML, eligible employees may take up to 12 weeks of combined family and medical leave per benefit year. By default, leave must be taken in full workday increments if taken intermittently. However, employees and employers may agree in writing to use a shorter increment. The shortest allowable increment under such agreement is 1 hour. There is a 7-day elimination period for leave related to an individual's own serious health condition. That elimination period does not apply when the leave is for newborn bonding or caring for a family member. Finally, leave entitlements are prorated. The amount of leave used by an eligible individual is calculated by dividing the number of hours taken by the number of hours in the employee's usual work week. Now, Maine PFML includes job and benefit protection for employees that have been with their employer for at least 120 days prior to taking leave. When an employee returns from a protected Maine PFML leave, they must be reinstated to the same or an equivalent position. That includes same pay, benefits, and other conditions of employment. It is important to know that this requirement applies for all employers, including the smaller employers. So everyone's held to the same standard when it comes to reinstatement, which is pretty unique for Maine. So what exactly are your obligations as an employer under Maine PFML? Well, first, employers should have started remitting collected premiums in the first quarter of 2025. This would have been due for the first time on April 30th, 2025. Like we've seen with many other PFML programs across the country, Maine will require employers to report employee wages and hours through the Maine paid leave portal. And finally, there is a notice requirement. Employers must provide all new hires with a summary of benefits available under Maine PFML in the employee's primary language. So that is key. It has to be in the employee's primary language. That notice must be given within 30 days of hire. Now, employees are expected to provide notice prior to taking leave, whether it's for family or medical leave. In terms of applying for benefits, they can submit an application as early as 60 days prior to the anticipated start date. If for whatever reason they're unable to apply in advance, they still have up to 90 days after the leave begins to submit that claim. Now, Maine has a pretty unique provision that we have not seen with other PFML states, and that is the ability to claim undue hardship. This provision would allow employers to claim undue hardship if a leave has significant impacts on the operation of a business or creates significant expenses. If an employer is claiming undue hardship due to a Maine PFML claim, employers must notify an employee in writing within 10 business days of learning about that leave. The written notice needs to explain how the employee's absence and the specific timing or length of that leave would significantly impact operations or cause a substantial cost. There are a few considerations that must be met for a claim of undue hardship to be considered reasonable. First, the employee must have the opportunity to take leave within a reasonable time frame. Second, an employer has to show good faith effort to accommodate the leave in a way that works for both sides. Now, here's an important caveat. If the leave is for a medical condition and the employer asserts that the timing would cause a significant operational hardship, the employer may propose alternative start and end dates. However, the proposed dates must be sufficient to accommodate that employee's healthcare needs. This would be based on the judgment of that employee's healthcare provider. So in practice, that means the provider can override an undue hardship claim if they feel that the timing of the leave is medically necessary.
Awesome. Thank you so much for going through that, Mathew. The undue hardship provision in Maine is, as Mathew mentioned, completely unique to Maine. And I know I personally am curious to see how it unfolds in practice, particularly on the state level and also in the private market. So it'll be interesting to see how that develops. But we've made it to, I suppose, more the meat and potatoes of our presentation today, which is where we're going to discuss the integration considerations. How do you mesh the Maine PFML program with your own internal accrued time off programs, PTO, sick, and perhaps you offer internal paid leave, paid parental leave, things of that nature. How do you make sure everything is clicked up and synced up in terms to create a seamless experience for your employees, but also to make things more administratively manageable for your organization? So I know there's a lot on this slide, and I'll try and take it from the top left and cover as much as I can. There are pros and cons to both sticking with the state plan and going private. And it is absolutely critical to have a balanced understanding of both options so that you can make an informed decision as an organization. A major factor in choosing to go private comes down to the difference you're able to attain in employee and employer experience. So in a nutshell, and summarized at a very high level, employees with access to private plans tend to have a more efficient claims experience overall. So they'll typically get a dedicated representative at the carrier who they can reach out to ask questions, clarify their claim, and ultimately impact the progression of their claim. And the same is true on the employer side. So employers will typically get a dedicated client service manager or team at their private carrier partner. They'll also be provided with a portal to interface with and drill into individual claims. They can run reporting and so on. The reason I mention these things is because this tends not to be the reality for employees and employers that utilize the state PFML program. So they may face significant support hold times in trying to reach a representative with the state program. In Maine's case, Maine is unique, and Maine took, you may be aware, took the approach of Connecticut in having a mandated PFML program, but outsourcing the administration of that program to a private organization, which is going to be AFLAC, the same as is occurring in Connecticut. So we'll have to wait and see the experience that AFLAC's able to provide out of the gates in terms of Maine PFML. But employees and employers may not receive that same level of claim continuity or dedicated, timely support or visibility as they would if they would utilize the private option. The state program is going to take a one-size-fits-all approach. So it won't matter if you're an executive at the largest employer in Maine or you're an employee of a small family business in the state. Everyone who calls in, employee or employer, will receive that same customer and claim service experience and overall timeline. Now, what else is an upside of considering a private plan? Generally, claims will pay faster on average. And so I like to give the example of, as a part of the metrics released by one of the recently launched state programs in another state, and I won't name names, they indicated that upwards of almost a year out of the program having launched, claims were taking an average of 30 days from the date an employee initiated them to receiving that first payment. And it goes without saying, employees have bills to pay, and an average wait time to receive a benefit check while you're out on leave and things are uncertain of a month means some folks may be waiting longer, and that could create noise for your organization. So I can say with confidence the private market is on average able to go through their process and release payments on a quicker timeline generally. Now, circling back to the portal topic, as an employer, being able to drill down into an individual's claim status or to run even wider reports to understand your organization's claims activity is a big plus of going private. That level of insight is rarely, if ever, available through a state-run program. And here's the key. It gives the employer, it gives you leverage to affect the claims process on behalf of your employees and potentially assist claims in progressing. So you're able to help things along. When employers are able to place their plan, so this is another big one, when you're able to place your plan with the same carrier that may already be handling, say, your outsourced short-term disability plan or your outsourced leave of absence administration, that carrier can generally offer additional consolidation within the intake experience for the employee. They can streamline the paperwork required. They can coordinate those various benefits seamlessly in terms of the calculations and also in terms of what's shown in their portal. It ultimately can paint a complete picture and create kind of a one-stop shop feel for both employees and employers. So that's certainly a best case scenario when you're able to nestle, say, STD, outsourced leave administration, and PFML with the same carrier. That tends to work very well. And what's more, by choosing to go private, you gain access to support from our team. So a shameless plug that we support the financial analysis, implementation, ongoing compliance support of these private plans to take that compliance burden off of your organization and act as your dedicated expert on the broker side. So ultimately, by choosing to go private, there's another layer of support you would access with us. The state does have its pros, so we'll pivot over to our top right section of the table here. The state plan is the default, and that means that most, if not all, private employers are automatically set up to be covered through the state program. There's no proactive steps you need to take to be considered enrolled in that program, if you will. Opting out, however, into a private plan requires proactive footwork, such as an application. There's typically a small application fee there. That'll be the case in Maine. It's a total of $500 if you're ultimately approved for your private plan. Some states are more efficient than others, so this is something to consider, especially for our multi-state organizations who may be joining us today. State agencies operate at different speeds, right? AFLAC is going to administer here in Maine. However, many states take the approach of having their state agency administer the program, and the outcomes vary across states. So while your employees may be having a hard time getting support or receiving a payout in one state, they may be having an efficient experience in another, which is an upside, but also a challenge, of course. And then when it comes to cost, many state programs have built into their legislation limits around how much premiums can change, either year over year or how high they can rise altogether. So I'll give you the example of Colorado. They've put a cap on their rate. It can't go beyond 1.2% of taxable wages. In Maine, Maine took the approach, which is unique, as I mentioned, of freezing their rate for the first few years at 1%. But otherwise, there's no cap that I'm aware of. And as I mentioned earlier, that does tend to give some financial predictability to employers that stay with the state. All right. Now, when it comes to downsides of going private, I do want to make sure to cover these. You will, as I mentioned, have to take some proactive steps to opt out of the state plan. You're going to need to choose a carrier, coordinate with your payroll vendor to get set up and opted out of their state plan setup. You're going to need to make sure your short-term disability and or your leave of absence administrators are aligned so that everyone is, communications are aligned in that aspect. Everyone's being directed to the right places. And on top of that, applying for the plan itself, it's not an arduous process, but it is a step you need to take as an employer, and that's per business unit. So if you have multiple EINs you intend to have covered under your plan, you would need to apply for each of them. So I like to be transparent about that. Beyond that, there are steps to maintain a private plan. As Mathew mentioned, there's going to be quarterly reporting due regardless of if you're state or private. There's a little bit more that the state will require if you go private. You'll owe an annual report. You'll need to reapply for your plan every 3 years to kind of get that approval resituated with the state, and they want that to happen on a 3-year cycle. So there's some things that you're going to need to consider and track. These are things that we at Cross Total Absence Management track and support on behalf of our clients. Another consideration, and this one is one that it's important to be aware of as an employer who is choosing to go private before things launch. When you choose to go private, the carrier is going to reach out to you on a per claim basis to collect a handful of pieces of employment and wage information. So wage history, schedule, and so on. This product is unique. The private plan is unique in that it isn't not typically one where a private carrier would put a data feed in place to collect that information. It's because the way that these state PFML programs define wages can be a little tricky to feed. So with that, the carrier will request this information manually on a per claim basis to gauge an employee's eligibility. If you as an employer were to say drag your feet on answering one of those requests, it could end up delaying an employee's claim. And so I just want to be clear, there's one additional step or hurdle you need to take on a per claim basis to get those claims initiated from your perspective. I do want to say most employers are able to find efficiencies in completing that, and it tends not to be an issue for most organizations. The last one is that the carrier, based on experience and other factors, of course, if you choose to go private, can always move your rate up beyond the state's rate. So you may begin with a competitive private plan rate. You're saving money. Your rate is below those states' 1% rate, and that creates financial incentive to go private. But after a year or two, the carrier may decide based on experience to increase your rate up above that 1%. And you would need to make a consideration there in terms of financials aside, are there other benefits to staying private? And of course, for all the reasons we just went through, there's certainly a lot to consider when making that decision. And I'll move on in the interest of time to our next slide. And we'll start in our top section, paid family and medical leave supplementation. So what our first bullet point here is intending to capture is that employees are not intended to receive more than their typical weekly wage when they're out on PFML, when combining that PFML benefit with any short-term disability your organization may offer or any internal paid leave policies your organization offers. So in other words, an employee shouldn't make more while they're out than they do while they're working. Of course, that can create an incentive to claim if you're profiting on leave, and that's something the program intends to avoid. Now, looking at our second bullet, this is a pretty important one. The rules and regulations, and taking a look at them, we aren't quite clear on how the state will structure the supplementation of accrued time off with paid family and medical leave. And what I mean by this is paid family and medical leave may cover a certain percentage of an individual's wages and leaving a gap. And the question on a state-by-state basis is, will the state allow employers to force employees to top up that missing amount with accrued PTO or sick? will the state allow employers to just make a choice, like we're either going to require you to, or we're not going to allow it altogether? You can't supplement with PTO or sick. Or will the state take the approach in the legislation of putting that choice up to the employee, meaning the employer has no control and the employee decides whether or not, hey, you know, on this leave, I'm going to go ahead and supplement my PFML. I have some sick time I want to burn through, or I'd rather not. So that is not yet defined. We do expect forthcoming rulemaking on this. What we do know in Maine is that the accrued time off can be applied during Maine's unpaid medical waiting period, so that 7-day waiting period. We also know an employer can't compel an employee to claim PFML benefits. This is super important. You can't force your employees to take PFML. It's a choice. And if they dig their heels in and they decide, you know, I'd like to use PTO right now, I'm not concerned with the job protection or the benefits that come with the PFML program, technically able to do that. Now, also for what it's worth, oh, pardon me. I'm losing my train here a little bit. There are always ways to integrate, right, your paid family and medical leave program into your internal policies to make it much more likely that your employees are going to claim PFML when applicable. And we'll talk more about that in our bottom section here. So moving down to paid family and medical leave integration, we do recommend evaluating your PTO program to consider aligning aspects of the program with aspects of Maine PFML. So, and pardon me, I have my dog visiting me here. Think about eligibility, right? Consider adjusting your PTO program eligibility to match or come closer to PFML's broader eligibility. You can look at your accrual structure. You can structure your PTO accruals to support shorter term needs, kind of reserving that PFML entitlement for the longer term needs. And this helps to reduce pressure on your PTO bank for longer absences. And then you can also consider balancing accrual rates to prevent excessive PTO accrual, which may, you know, when employees are accruing mass amounts of PTO, it does kind of create a temptation to stack or to claim PTO and then claim PFML, extending your total time away. So perhaps by balancing your accrual, you'd be able to turn the knob down on that incentive just a bit. And then rollover, if you're currently allowing an unlimited or a generous PTO rollover, same logic applies. Consider capping it. Consider switching to a use it or lose it model, so that employees don't bank excessive PTO that can be stacked against paid family and medical leave. Now, critically though, remember some of these PTO program changes would be perceived by your employees as a subtraction or as a takeaway. So a solid financial impact analysis to make data-driven decisions, and really solid change management communication, capturing the why of the change, are absolutely critical going into it, both of which we would support from the cross total absence management side. And just to add to that a bit, you know, there's a natural reluctance we see on the part of employers to pull the trigger on some of these changes, especially in the first year of a program, not knowing what the utilization is going to look like. Rest assured that it's okay to wait for the data you need to feel comfortable pulling those triggers. The important thing is that you're aware and considering that they could be pulled, if you will. And also, critically, we don't have firm guidance yet around whether the ability to supplement PFML with PTO or sick will be up to the employer or the employee. So if it's up to the employer, if it's up to the employer can choose to require it or prohibit it. Whatever approach is taken, we do recommend applying that approach consistently across your employees. One consideration is it would draw down the balance, which is good for employers. So if you do require it. Another is it would further financially disincentivize an employee to return to work, considering they're now receiving 100% of their regular wage instead of the state maximum. So if you do allow and you do require employees to supplement, them receiving a more complete benefit does have that effect, right, of disincentivizing a return. Now, another thing to consider here is how the supplementation can be achieved if it is allowed. So regardless of if it's up to the employer or the employee, it's important to make sure your payroll system or your internal team is prepared to actually administer applying a supplemental PTO or sick time amount on top of a PFML benefit. So certainly important to make sure that you have a strong function built internally to handle that. Now, I'm going to, in the interest of time, because I could talk about this forever, as you may be able to tell, I'm going to skip down to our last bullet. How can you drive utilization of the PFML benefit within the setup of your paid leave policies that you may offer internally, you can take the approach of adding clear language to your policy that employees are eligible for internal paid leave minus any statutory PFML benefits they may be entitled to. So what you do by building that stern language into your policy is, if an employee were to fail to claim PFML they may be eligible for, they'd receive a reduced internal paid leave benefit, unless or until they could provide proof to you as an employer that they applied for that PFML and were ultimately denied, at which point they could receive an unreduced internal paid leave benefit. So by the prospect of such a significant offset tends to do the trick in pushing employees to go through the proper steps to file for PFML when also applicable. Okay, I know that was a lot. Hopefully you're still with me here. We're going to switch gears a little bit to the demographic analysis, and we're taking a look here at one of the tools we use at Cross to understand the viability of the private PFML plan for employers from a financial perspective. So we'll ingest the census, or simple census, and our model will generate first a heat map, which is what you're looking at here, to understand where in the US your organization may have exposure to a mandated PFML program with private options. Of course, this is just dummy data here, so you see everyone showing up in Maine, but typically we'd have a smattering of results on our map here. And here's some of the other outputs that would be included in the demographic analysis. We have gender split, age, wage band distributions. But I'll let you, Matthew, go ahead and take over and show us what else our impact analysis can tell us.
Yeah, so this slide really outlines the annual payroll tax breakdown based on the census data that was provided. We're able to show the employer and the employee portion of the premium, which is showed at the top, given a clear view of the total estimated tax obligation under Maine PFML. You'll also see the total covered payroll reported within the state, which is at the very bottom, which helps put the premium amount into context and allows for accurate planning and budgeting. So our impact analysis provides a data-driven estimate on how Maine PFML may affect your workplace in a typical year. Using that simple demographic data that was provided, along with benchmarking from FMLA trends, U.S. Census Bureau data, and insight from our own book of business, we're able to estimate the total number of continuous leave incidences that you can expect annually. In addition to that leave volume, we also project total lost income for employees, total number of FTEs lost, and the estimated benefits that would be paid out under Maine PFML. Again, this is annually. When it comes to decision, there's a lot of factors that we take into consideration. We have a lot of valuable insight from our impact analysis that you've seen so far, but really the key question still remains: what's the best option for a specific employer? Is it that state plan, or is it a private equivalent plan? As I mentioned, there's a number of factors when we consider when making that recommendation. The key is if that estimated benefits being paid out under the program are less than the employer's portion of the payroll tax or the total payroll tax, it may make financial sense to pursue a private equivalent plan, since that would be most likely the lowest cost option. On the other hand, if the estimated benefits paid are more than the employer or the total tax amount, then the state plan will most likely provide the lower cost option. So there's several things we consider when making that recommendation and determining what that lower cost option would be. Now, let's use this framework and use the data from this dummy group to see what direction would make most sense for them. In this case, the analysis actually shows something important. While the estimated annual leave benefits for this group is higher than the employer portion of the payroll tax, which is shown at the very top, the estimated annual leave benefits are still lower than the group's total payroll obligation. So that's the second set of data you see here. So when looking at this full picture, A private equivalent plan would most likely be the most cost-effective option for this specific employer. Opting out for an equivalent plan would allow the employer to collect the employee portion of the Maine PFML premiums to offset the cost of providing the Maine PFML benefits. And with that, we're going to open it up for some questions. We're going to do our best to get through all the questions. If you have any unique, some very specific questions that we're unable to answer here, we'll get in touch with you after this presentation. But yeah, let's open it up for any questions.
And I want to add for the group, thank you so much, Mathew. The impact analysis Mathew just finished going through, something that we're happy to run for your organization. If you're interested, you want to get a snapshot of whether it makes sense financially, you can reach out to us after. We'll be able to provide our contact information. So something you certainly have access to. But Mathew, I see a couple questions in the comment section here. And so the first one is, do I still have to file quarterly reports with the state if I go with a private plan? Is that something you want to speak to?
Yes, you will have to. You will have to still report quarterly, and that is through the Maine paid leave portal. So that is that wage and hours reports for all your employees within the state of Maine.
Yep. And the only difference, right, if you go private, is that you won't have to submit that tandem premium payment. They won't expect payment, if you will, with the exception of Q1 currently. So this first quarter you will, but then ongoing, assuming you're approved for a private plan, beginning Q2, you wouldn't need to beginning with Q2's reporting, if that makes sense. Other question we got was, and then I see a couple more. Does it only make sense for larger businesses to go with a private plan, or are there scenarios where it makes sense for smaller? So I'll speak to that one briefly, and I'll just say that the private plan tends to make sense for both small and both large employers. Many of our private market private carriers may have a minimum threshold in terms of the smallest employer size they're willing to work with and put a private plan in place, and those can go down to the 10s or the 15s or 50s range. But that being said, we support employers of all sizes, from that small all the way up to the multi-thousands, with private plans in multiple states. And what's more important are the, say, demographics, the industry you work in, age distribution. These are things that will impact where the financials land in terms of the private option. Now, does it make sense administratively? I think it's important to consider, what does your utilization look like? How robust are your internal processes? How complex are your internal policies? Do you have the manpower, if you will, internally to field questions that come with this program, deal with delayed or tricky claim situations with the state? If you think going with the state and having some of those hurdles I discussed would pose problems for your organization, just based on the nature of how your leave activity looks, I think it's really important to consider the private option.
Yeah, and Rich, I would add to that, if you're a small employer, less than 15 lives, a private equivalent plan might not make sense. That's just because of the way the contributions, the rules are set up, where if you're over 15, then the employers do have to contribute as well. Under 15, they can just take the employee's wages and not contribute on their end. So it might not make sense if you're less than 15 lives to do a equivalent plan, but we can always look into those options.
That is a great point. It would likely remove the financial incentive, since it'd be hard for the private market to get down that low to only the 0.5% that you would owe as a small employer in Maine. But then again, the employee experience is critical, right? So if that's your concern as an organization, and you're not worried about the cost because you care how things work for your folks when that time comes for them to claim, then by all means, the private option is still something you can consider. Okay, a few more here. What level of savings have you seen early on in adopting private PFML plans? That is a great question. We see a lot of savings when you adopt PFML, first from the way that these programs tend to structure the rollout. So of course, you may be aware we have a unique opportunity in Maine. If you choose to go private, you can exempt yourself from many months of contributions leading up to the 5/1/26 launch of this program. So as things are currently written, all employers will owe for Q1's contributions, but exemption from those contributions for both employee and employer can begin if you choose to go private as early as Q2 currently. So that's about 13 months of saved employee and employer contributions, which depending on the size of your organization, of course, can be substantial. Now that alone, often we're seeing on top of that, those savings, the private market is able to come in competitively with the state's 1% rate. And if you're able to secure a rate below that 1% and even better, secure that rate for an extended guaranteed period of time, the savings can be substantial. So hopefully that answers that question there. Oh, great question. Another one here. What's the best, and I'll ask Matthew, go for this one. What's the best way to go about evaluating the approved private plans and comparing them?
Yeah, so the approved private plans, they're going to all offer the same, similar policy to the state. They have to meet that minimum, guideline. So they have to be approved by the state to be able to offer an equivalent plan. When it comes to the main differences that we're going to see across the board is what type of service they provide, how they're structured. Here at Cross, we actually track a lot of that information, and we also have been documenting any issues we may have run into with these individual carriers, so that we can compare them side by side, look what's the most important for that specific employer, what they're looking for when it comes to service, ease of use, portal, all those main topics that we hear about, and then we can make a good decision on, or help you make a good decision on which carrier might be the best fit for you. One thing that I would want to say is, if you currently have other lines of coverage, say with a carrier ABC, it might make sense to add a private equivalent plan with them. It just makes it a lot easier for employees, one-stop shop, etc. So those are all considerations that come to mind when looking at the different approved private plans available, and what might make sense for a specific employer.
Awesome. We got another good question here, which I can speak to. Have you experienced any challenges with payroll companies moving to private versus state plans? And the answer is yes. That's a very great question, timely question. We deal with them with the launch of any statutory PFML program. What we typically see is that your payroll vendor will likely assume that you are going with the state of Maine in Maine. They'll assume you're sticking with the state program. So they're going to have a default tax setup. They're going to say, they probably set you up already with pulling the 0.5% from employees as a default. And then they'll, as a default, likely remit those at the end of Q1. And they'll plan to continue doing that unless you intervene and proactively coordinate with them and make them aware that you have pursued the private option. Here is what our private rate will be. Here is when our exemption begins. Please work with me to ensure you are not going to be remitting future quarters of contributions to the state, and that we've updated our deduction codes within the system to be accurate to our private setup. In a nutshell, and I know I'm rambling, payroll vendors aren't quite savvy on the private option, and they need handholding and they need proactive coordination to really get them to a point where they know what you have and they're set up to accommodate it. So whether you have ADP or whatever system you use, get ahead of the conversation. And if you haven't already, especially if you're considering going private with that exemption beginning with Q2 here, get on those conversations. And those are conversations that we support for the clients that we help with their PFML plan.
Yeah, I would add to that, these payroll vendors, they're getting more familiar in the PFML space as more states go live with their programs. We are pretty hands-on when it comes to the implementation process, making sure that the payroll vendors are set up and ready to go, allowing enough time to make sure everything's in place for that go live date, because we have had some issues with remitting those contributions and sending it to the state instead of an equivalent plan. So we want to make sure everything is ready to go prior to go live.
Yeah, and it can be tricky, right? If you accidentally get those remitted, I know, speaking to some situations we had in Oregon, is one of our more recent programs, so it comes to mind often, is we had those situations occur where employers didn't get ahead of the conversations with their vendor. Contributions got remitted to the state that shouldn't have been, and it took, in some cases, upwards of a year to get them back from the state, which is a journey nobody wants to embark on when they're dealing with the noise of a new PFML program in the first place. So, of course, that could be a hornet's nest for sure.
I think we have time for one more question, guys, that I see here in the chat. Are there still savings that people can achieve past the first quarter deadline?
Yeah, I can speak to that one. So end of May, the deadline you're looking at this month isn't the deadline of if you miss it, you can't go private, right? Don't interpret it that way. Applying for a private plan by the end of this month simply would secure you a seat in line for the earliest possible exemption from contributions that the program offers. So if you want to save as much pre-funding as possible for your employees in your company, you would want to apply for your plan by end of May. However, the way that leading up to 5/1/26, the way that the timeline will work is it'll roll on a quarterly basis leading up to May of next year, where let's say mid-June, you say, you know what, we'll pay him Q2 contributions. We didn't get ahead of that end of May deadline, but we want to go private still. We would, support your organization, get you set up with your private plan, get that application submitted a month prior to the end of next quarter. And what that would do for you is it would allow you to go effective, playing with dates in my head. Your exemption would be effective Q3, so 7/1. So you would essentially have to remit Q1 and Q2 in this example, but you're still realizing 10 months of savings leading up to that 5/1/26 benefit launch. So it's not a drop dead deadline. The savings, the most possible, are available now, but you still have access to them leading up to the program. And even if you wait, right? Even if you wait until after May, let's say you wait until 2027 and you decide the state's program has been rockily administrated by AFLAC and our employees aren't having a great experience. We want to test out the private option. You may still receive a competitive quote below that 1%. You won't get the pre-funding savings, but you and or your employees would realize savings on the premiums themselves. So the savings potential doesn't quite go away ever with this option.
Great. Thank you so much. And actually, that's a good note to end on, because one thing I failed to note at the top that we're also concerned about with this program is with the state program, it's set at that 1% through 2027. But then starting in 2028, the Paid Family Medical Leave Authority can reevaluate that contribution amount based on how much the program needs to be solvent. So there'll be many opportunities over the coming years for employers to check in and see if they're still getting the best deal, whether it be state or private, as the program evolves. So Rich and Mathew, thank you so much for your presentation this morning and for carefully answering everyone's questions. My biggest takeaway is that the biggest savings for those looking to adopt a private equivalent plan is if you get in that application by May 31st, but there'll still be plenty of opportunities after that should you not be able to evaluate your options by that date. And I also want to thank my colleague, Riley Legier, for helping to produce yet another successful virtual event. And last but certainly not least, thank you again to everyone watching this morning. If you're interested in continuing the conversation with Cross Total Absence Management Team and learning more, please be sure to check your email for a follow-up message with additional resources. And of course, I want to give another shout out to our sponsor, Eaton Peabody, for their support of this series. The Eaton Peabody Growth Basics for Business series is typically held on the third Tuesday of each month. Join us next month on Tuesday, June 17th, for another informative training using social media to drive sales, which will be presented by Stephanie Miller, who is a mentor at SCORE, and that'll be our final event of this season of Growth Basics. If you are interested in presenting at Growth Basics for Business, or you know of an industry professional who may be interested, please visit our website, portlandregion.com, and you can submit any event proposal there. Any questions, our team's direct contact information can also be found on our website. So thank you so much for attending today's event. Have a great day, and we'll see you next month here on Growth Basics for Business. Bye-bye.